Here is the uncomfortable truth about how money is actually made in financial markets. The moment a story becomes exciting enough to share, exciting enough to screenshot, exciting enough to light up your notifications, that moment has already passed. The positioning is done. The early money is already in. What you are seeing on your screen is not an opportunity. It is a recap. The real opportunities live somewhere far less glamorous. They live in the dry regulatory filings, the institutional press releases, the committee calendars, and the conference rooms where people with $1 trillion under management say things that never quite make the front page. And right now, in this specific moment, one of those rooms produced a sentence so significant that it should have stopped the financial media in its tracks. It did not. But we are going to talk about it today, because that sentence is the key that unlocks every single XRP development happening right now, all at once, in the same extraordinary window of time. Before we begin, the standard and important note. Nothing you hear in this video constitutes financial advice. This channel exists to deliver clear, fact-based analysis so you can make your own informed decisions. The research and conclusions are mine. What you do with them is entirely yours. Let us set the scene properly, because context is everything here. While the broader crypto market has been fixated on price charts and short-term volatility, while the XRP price has been hovering around the $120 mark and the fear has been loud and persistent, something has been unfolding underneath all of that noise. Something slow, methodical, and potentially far more significant than any single price candle. The global banking system's foundational payment infrastructure is being rebuilt, and the fingerprints of Ripple's technology are all over the blueprints. Start with SWIFT. If that name is unfamiliar, here is the 30-second orientation you need. SWIFT is the financial messaging network that connects over 11,000 banks across more than 200 countries worldwide. It is the invisible backbone through which virtually every cross-border bank transfer on Earth has been processed for decades. When your bank moves money internationally, it almost certainly passes through SWIFT. It is not an exaggeration to call it the central nervous system of global institutional finance. And SWIFT just announced a comprehensive new cross-border payments framework. Not an incremental upgrade. A full architectural overhaul built around 3 core capabilities: instant settlement, fixed, transparent transaction fees, and complete end-to-end tracking from the moment money leaves one institution to the moment it arrives at another. If those 3 features sound familiar to you, that is not a coincidence. Those are the exact capabilities Ripple has been engineering, promoting, and building its entire commercial proposition around for the better part of 10 years. Instant, transparent, trackable. The overlap is not subtle. More than 50 banks have already committed to this new SWIFT framework, and these are not regional credit unions or community banks. JP Morgan, HSBC, Citibank, BNP Paribas, Deutsche Bank, Bank of America, Santander. These are the institutions that collectively move an almost incomprehensible share of the world's daily financial volume. More than 25 of those banks are scheduled to go live on this new framework before the end of the current month, activating coverage across some of the highest volume payment corridors on the planet: Australia, Canada, China, Germany, India, the United Kingdom, and the United States. The obvious narrative at this point writes itself. SWIFT is fighting back. The legacy system is modernizing to neutralize the Ripple threat. Pick your team, and that is exactly the story most people will carry away from this development. But there is a detail buried in the announcement that reframes everything. Of the 50-plus banks that SWIFT identified as launch partners for this new framework, at least 30 of them already have documented active relationships with Ripple's technology. Not historical pilots from years ago. Active, ongoing connections. Santander, one of the largest financial institutions in Europe, routes its international transfers directly through Ripple. Deutsche Bank has been operating a deliberate hybrid model, running Ripple's infrastructure in parallel alongside Swift's messaging systems. HSBC, Standard Chartered, Bank of America, JP Morgan, all of them have not merely experimented with Ripple's technology but have integrated or piloted it at various operational levels. And critically, none of them appear to be walking away from those connections as they adopt Swift's new framework. These institutions are not choosing sides in a technology war. They are doing what sophisticated institutions always do. They are hedging their infrastructure across both systems simultaneously. Swift never mentioned Ripple's name anywhere in its announcement. Not once. Yet 30 of its most significant launch partners are actively wired into Ripple's ecosystem at the same time. This is not a competition. This is two complementary systems quietly merging their operational reach without either one publicly acknowledging the other. Now, you might reasonably think that the scope of what we just covered would constitute more than enough news to define an entire month in the XRP story. It does not. Because at essentially the same moment that the banks were activating Swift's new infrastructure, something was happening in Washington that will determine the legal speed limit for everything those banks are permitted to do with digital assets going forward. The legislation in question is the Crypto Market Structure Bill, widely referred to as the Clarity Act. On the 1st of this month, it was formally placed on the United States Senate's legislative calendar. This followed its successful passage through the Senate Banking Committee. With Congress back from recess, the bill now sits fully eligible for a complete Senate floor vote. Most people, when they hear this kind of news, imagine the payoff as a future event. They picture the signing ceremony, the photograph, the press release, the candles turning green on the chart, and so they wait for that moment. That is a fundamental misunderstanding of how capital markets process legislative probability. Markets are anticipatory mechanisms. Professional institutional traders are not waiting for certainty. They are pricing probability. The repricing of an asset class does not happen when a bill is signed. It happens progressively, accelerating sharply when passage becomes sufficiently probable that large institutions can no longer justify staying on the sidelines. Call it the clarity shock. The market absorbs the outcome before the outcome officially arrives. And the signals coming out of Washington right now are not ambiguous. Senator Cynthia Lummis, who has been among the most knowledgeable and engaged voices in the Senate on digital asset policy, made a statement that deserves to be read very carefully. She said that the United States is closer to establishing a functioning digital asset market structure than it has ever been at any point in history. And she followed that by saying that this is not the moment to flinch, not the time to flinch. From a sitting United States Senator at this stage in the legislative process, that is a statement loaded with implication. The volatility you have been watching in XRP's price right now, those swings that create anxiety in your gut, that is not random. That is the market pricing uncertainty. The entire digital asset space is currently valued around a question that has not yet been officially answered. What exactly are the rules, and who has the legal authority to participate? The moment that question receives a definitive legislative answer, the uncertainty premium evaporates, and every major institution that has been holding back deployment of digital asset capital while waiting for regulatory clarity receives its green light simultaneously. The question is not whether that moment is coming. The question is whether you are positioned before or after it arrives. Infrastructure and legislation are two foundational pillars. But a structure built on two pillars is unstable. There's a third element that most coverage of this story entirely misses, and it may be the most operationally important piece of all. Consider the fundamental question that nobody seems to ask when discussing blockchain-based banking infrastructure. If you build a new settlement system on distributed ledger technology, shared ledgers, tokenized assets, real-time bank rails, what is the unit of value you actually settle in? You cannot run regulated institutional capital through an asset that lacks regulatory standing. You cannot denominate trillion-dollar banking transactions in something that compliance departments cannot legally approve. you need a digital dollar. One that has been built to satisfy institutional and regulatory requirements from the ground up, not retrofitted to meet them. That is the precise role that Ripple's stablecoin, RLUSD, is designed to fill, and its growth trajectory has been remarkable. RLUSD recently expanded its presence into Turkey through 3 new partnership agreements, and since its launch less than 1 year ago, it has grown to over $1.7 billion in total market capitalization. To put that in context, that represents one of the fastest stablecoin growth curves the market has recorded in recent history. But the capitalization figure, impressive as it is secondary to what the asset actually is. RLUSD was built and issued under a New York trust charter. It is backed 100% by U.S. dollar deposits and short-term U.S. Treasury instruments. For the compliance teams and legal departments inside major financial institutions, those are the exact structural characteristics that convert a digital dollar from a question mark into a viable operational tool. RLUSD was not designed to compete with retail stablecoins. It was engineered specifically to be the kind of asset that a bank's risk and compliance infrastructure will approve. Now connect all 3 threads deliberately and slowly, because this is the convergence that makes this moment genuinely unusual. SWIFT is activating a new cross-border payments framework this month, with 30 Ripple-connected banks, and is simultaneously reported to be developing a blockchain-based shared ledger for tokenized value that is moving toward real-world operational testing. RLUSD is scaling rapidly as the institutionally compliant, regulated digital dollar purpose-built to function as the settlement layer on exactly that kind of infrastructure. And the Clarity Act is positioned on the Senate floor ready to extend full legal authorization for U.S. financial institutions to participate in this ecosystem. 3 separate developments, 4 separate institutions and regulatory bodies moving at the same time, and the XRP ledger sitting at the architectural center where all 3 converge. This is not a collection of loosely related news items. This is a single story arriving through multiple channels simultaneously. Now, I made a promise at the opening of this video. I told you about a room, a woman managing more than $1 trillion, a Bitcoin maximalist seated directly beside her, and a sentence that should have dominated financial news and somehow barely got covered. It is time to deliver on that. The woman is Jenny Johnson. She is the Chief Executive Officer of Franklin Templeton, an asset management firm overseeing well over $1 trillion in assets. When someone operating at that capital scale makes a public statement about the direction of money flow in financial services, it carries a different weight than commentary from analysts and commentators. And here's what she said, with a Bitcoin maximalist seated right next to her. She said that Bitcoin is the greatest distraction from the greatest disruption happening in financial services today. Take a moment with that. The CEO of a $1 trillion institution is not dismissing crypto broadly. She is redirecting attention. Stop fixating on the theological debate, she is saying, the believers against the skeptics, a religious argument in her framing where neither side will ever persuade the other of anything meaningful. Look past that argument entirely. The disruption that actually matters is happening in the infrastructure underneath. The blockchain technology, the utility, the actual rails moving real value between real institutions. That is the story. And if you have been following Ripple for any length of time, you will recognize immediately that what Jenny Johnson just described in that room is the exact commercial thesis Ripple has been executing on, said publicly, on a visible stage, by the head of a $1 trillion asset manager. She is not simply offering an opinion. The institutional wiring already reflects where Franklin Templeton and its peers are actually placing their operational bets. Ripple's gateway technology reportedly maintains live connections to Bank of America, Goldman Sachs, Deutsche Bank, J.P. Morgan, PNC, and HSBC. Multiple institutions from that list are simultaneously tied into Ripple's custody infrastructure, and Ripple's treasury tools are reportedly undergoing integration with Swift's global messaging architecture, creating a pathway for banks to eventually maintain blockchain-native digital asset accounts, including XRP, running directly alongside their legacy Swift systems. The picture that emerges is this. The world's largest banks are simultaneously connected to Ripple's custody layer, Ripple's gateway infrastructure, and Swift's newly upgraded cross-border framework. All three at once. While the XRP price sits at $120 and anxiety runs high in the retail market, institutional infrastructure is not being torn down. It is being built up. The institutions that are plugged in do not appear to be guessing about what comes next. The evidence suggests they already know. At this point, some of you are sitting with a familiar and completely reasonable skepticism. You have heard variations of the phrase almost there applied to XRP before. Multiple times, across multiple years. And the promises that felt imminent turned out to be further away than advertised. That skepticism is not cynicism. It is earned, and it deserves a direct and honest response. XRP's delayed progress was never fundamentally a technology problem. The XRP ledger performed. The transaction speed was real. The cost efficiency was real. What was not real was the operating environment. The obstacles were regulatory, legal, and political. And they were thrown in front of this technology with what, in retrospect, looks like deliberate consistency. The SEC lawsuit against Ripple was not a routine enforcement action. It was an existential legal threat that froze institutional participation for years. The regulatory gray zone around XRP's asset classification paralyzed the compliance departments of institutions that might otherwise have moved far faster. And the political environment in Washington created a climate where crypto companies faced what appeared to be coordinated institutional resistance rather than good-faith regulatory engagement. Here is the current status of every one of those obstacles. The SEC lawsuit against Ripple is finished. It resolved in Ripple's favor. XRP now has established legal status in the United States. The Clarity Act is on the Senate floor. Ripple has built a meaningful presence in Washington and is actively participating in the policy conversations that will shape digital asset regulation going forward. And the regulatory tone shift has been documented directly at the federal level. A senior official at the Commodity Futures Trading Commission recently stated on the record that the previous administration used federal regulatory agencies as instruments against the crypto industry. He specifically identified the Winklevoss twins, the founders of Gemini Exchange, as among those who were politically targeted through regulatory mechanisms. He stated directly that they are committed to righting those wrongs and approaching the industry with a clean slate going forward. That agencies are not tools for what he called lawfare. Parse what that statement actually represents. A federal regulatory official is saying, on the record, that the campaign of regulatory hostility directed at the crypto industry is not slowing down or being re-evaluated. It is over. So take stock of where everything stands simultaneously. The SEC lawsuit, resolved. XRP's legal status, established. Clearing legislation on the Senate floor. Banking infrastructure, live and expanding. Regulatory posture, formally reset. Institutional positioning, active and documented. For years, the response to when does this finally move was consistent. It moves when the legal clouds clear, when the regulatory framework exists, and when the institutions are positioned and ready. Every single item on that checklist is being addressed inside the same 30-day window. That has never been true before. Not simultaneously, not like this. Markets do not move when announcements are made. They move when enough participants simultaneously recognize what has already quietly happened. We are living inside that recognition window right now. Let us pull back and see the full picture from altitude. SWIFT is activating a new global payments framework this month, powered largely by banks that are simultaneously wired into Ripple's technology infrastructure. SWIFT is also reportedly moving toward a blockchain-based shared ledger that would handle tokenized value at institutional scale. RLUSD, the regulatory-grade digital dollar built on the XRP ledger, has grown past $1.7 billion in market cap in under 1 year and is now expanding internationally. The Clarity Act, the legislation that would establish the legal framework for institutional digital asset participation in the United States, is sitting on the Senate floor ready for a vote. The SEC lawsuit is behind Ripple. Federal regulators have publicly acknowledged past overreach and committed to a reset. And the CEO of Franklin Templeton, speaking in front of the financial industry, has pointed directly at blockchain utility as the defining disruption of our era in financial services. The fear in the market is real. The price chart does not yet reflect what the infrastructure chart is showing, but that gap between what the price says and what the underlying architecture says is not permanent. It is precisely the kind of gap that closes when recognition arrives. And the evidence suggests that recognition is not somewhere on the distant horizon. It is approaching. The fear is always at its loudest in the window just before the picture becomes clear. The steady response to that fear is not dismissal. It is research. It is slowing down when others speed up. It is reading the documents nobody clips. It is watching the room where the trillion-dollar CEO says something that should have been front-page news. That is where this story has been hiding. Now you have seen it. Drop a comment and tell me which of these 3 threads carries the most weight in your view right now: the SWIFT wiring and banking infrastructure, the Clarity Act and regulatory reset, or the RLUSD expansion and the institutional dollar layer. Every comment gets read. I genuinely want to think this through with the community. If steady, fact-driven analysis is what you want more of in a market full of noise, you already know where the subscribe button is. No pressure. The seat is always open. Eyes on the facts, head clear, position steady. I will see you in the next one.